Hey everyone, today we are sitting down with Leyton Peterson with Willow, Glen Insurance to talk about property insurance here in the multifamily market. Insurance is rapidly changing, and we want to make sure we get a professional on the channel to provide insights as to what's going on to help empower people to make informed decisions with their real estate. So, Leyton, thanks for being here and jumping on this Zoom call.
Yeah, thanks for having me. Appreciate it.
If you don't mind, please give the viewers a little intro on who you are and what you're about.
Sure. So I am a commercial insurance broker, primarily focused on investment property. Say about 95% of my clients, have investment property, whether that's apartments, large portion of that, shopping centers, office buildings, you name it. I insure that. Been in the industry for over 10 years now, and trying to write some more business.
Well, that's great. Well, we've already had a lot of engagement with you with insurance on some of the buildings we have, and then also referrals through other clients. You've helped out a lot of people already, so thank you for that. If you don't mind, let us know, why is insurance becoming so challenging in California right now?
The short answer is insurance companies have been losing money. Uh, and there are a lot of factors into why that has happened. We've seen one of the biggest reasons, at least on apartments specifically, habitability claims are a huge pull. And for those who aren't familiar, uh, tenants are able to sue a landlord for uninhabitable conditions at an apartment building. We'll see attorneys simply walk into parking lots, ask tenants, "You want to sue your landlord?" Uh, they say yes. They get a $25,000-$50,000 payout, somewhere in that range, and insurance companies simply can't do anything about that. They lose those almost every time, just given how the laws are put together in California, very favorable for the tenants. We also have rising replacement costs. A couple years ago, something that maybe costs $150, $200 a square foot, now pretty consistently costing $300, somewhere in that range at least. So there's some other factors at play, but generally speaking, the claims have far outweighed the premiums, and insurance companies are pushing back and trying to find ways to mitigate those losses. Part of it is increasing rates, part of it is having more stringent underwriting guidelines.
So that kind of makes me want to ask two questions. Who's pulled out, and then how high are the premiums? How high have they gotten up to now?
Sure. So I'm sure everyone's heard State Farm's out. I imagine at some point they will come back into the market, given how big California is, how much business and opportunity there is. They don't want to pull out. I think it is kind of a testament to how severe it has been when a company is pulling out of one of the largest markets, in the world, truly, what California is. So they're out. Guard, which a lot of people, were insured by, they changed their guidelines to not insure any buildings older than 1990, which in California, 50s, 60s, 70s is when probably 95% of buildings were constructed. So they essentially got out of the market. Travelers has a similar stance. We've seen Farmers said, I think it's nothing older than 50 years old. Mercury will be very difficult on anything over 60 years old. AmTrust also came in. They said, we only want 1990 or newer. So a lot of companies have taken the stance. If they haven't completely gotten out, they've just changed it. So the years that they're willing to write effectively got them out of, 95% of the market.
But there's still insurance companies that will write policies on these older buildings because, like you said, the majority of apartment buildings in California were built in the 50s, 60s, and 70s.
Sure. So there's still companies out there. So there's a combination. There's two types of companies. So we have the admitted companies, the ones you've probably heard of. Capital Insurance Group is one. So CIG, Again, mercury's in the mix depending on the year built. We have the honeycombs of the world. So there are still companies doing that, and then there's the non-admitted companies. And they're not bad companies. They just go by different guidelines. They don't have to deal with getting rates approved by the commissioner, which has been in itself actually a big struggle. One of the reasons State Farm pulled out. So you get these non-admitted companies. They will write insurance on these older buildings. The problem you can run into is you won't have habitability coverage. It'll be limited. Some of the property coverage will not comply with lender requirements. That's something we can run into. So there's a big disconnect right there on the what the lenders want and what insurance is willing to provide. And then there's also the California Fair Plan, which is the government-backed insurance company that is, again, very limited, not going to comply with lender insurance requirements most of the time.
So what do owners of apartment buildings do to keep their properties up to a level that's going to satisfy lender requirements as things are, or insurance requirements as things are changing?
Yeah, so the big two as respects the systems are the electrical and the roof. So the roof being done, most companies want it done in the last 25 to 30 years. It's important. The electrical, again, when it's built in the 50s and 60s, they want to see that that's been updated. The big things most companies are asking about are the wiring. So knob and tube wiring and aluminum wiring are very unfavorable. And then we get to the panels. So there are certain brands of panels that are not desirable. So Cisco, Federal Pacific, and then you start getting into some companies are very specific. So the Sylvania, Challenger, every company has a little bit different approach. Fuses being another thing; those are just considered very outdated, and that will just be part of the eligibility questions that companies ask. So once you say yes to any one of those things, they're going to decline immediately. That's how it's been. That's how it's going to continue to be. I don't see any companies getting easier on that sort of thing.
Well, luckily, changing out the interior panels isn't too much work. It's not too much disruption. We've been able to get a lot of those changed out pretty quickly and do the drywall patching around and helping out our clients for that. So if you have an existing policy, are you grandfathered in?
Yes. So, and that's some of the disconnect I think I've seen some sellers and buyers not understand. A seller says, I have a policy that's, X amount, and they're fine with the panels or the wiring or the roof. Well, you were underwritten, so many years ago, and the underwriting guidelines were different. And now a new buyer has to adhere by a new company's guidelines, and they are, much more stringent, far more questions. Even 5 years ago, you give me a property, how many units, year built, roof, some real basic information, and I can get you a quote. Today, I've got a laundry list of questions about all sorts of things. And so I just think sellers need to understand there is such a big difference from when they originally procured that policy to what the buyers have to get today and what they have to go through. It's quite a bit different.
So if you're a seller of a multifamily property, I would guess based on what you're telling us, we would advise our clients that are selling to know what panels you have, if you have any of those that are red flags, Federal Pacifics, Zenscos, to have those replaced prior to selling possibly, or what would you recommend?
Ideally, if you don't want to run into issues and people, buyers asking for credits and everyone's trying to get it figured out, if you want a smooth transaction, having those kinds of panels, wiring, a roof that hasn't been replaced in a while, you will certainly run into struggles on the insurance side. The buyer will, at least. So, I know you guys have experienced that. Everyone I work with is having those challenges. Another thing I would include is just the general maintenance of the property. Companies are pulling up the property whenever they get it in, and they are looking at the just general maintenance of a property. Is there peeling paint? What's the driveway look like? Is there cracking, potential trip and fall hazard? Does the landscaping look nice? Is that being tended to often? Is there trash overflowing from a dumpster? Do the railings look like there's too much separation? Do they look high enough? There's a lot of items companies are looking at. So I think more than ever, pride of ownership is being considered when insurance companies are evaluating a building.
Right. No, that makes a lot of sense. That's really good information. Um, it seems pretty overwhelming for a lot of owners that are selling to have this new curveball with a buyer's insurance now becoming their issue. But it's definitely real. I mean, some of the inspections we've had recently on a couple escrows, the buyer included their insurance advisor to walk through the building, and they saw the panels, and they saw, so it became a lender requirement to have the panels changed out prior to close as a condition. So some of these things were just pushed onto the buyer to do post close, and maybe the insurance company would give the buyer a year to complete these items and then make sure they're cured and they're good to go. But now that doesn't seem like it's the case. Or if it is, you tell us. If it is, it seems like the premium is just way, way higher.
Right. I would say definitely less accommodations being made by insurance companies. One of the reasons is, if they say, hey, we want the panels done within 90 days, it's not even possible. Uh, just getting the panels in 90 days would probably be a miracle. Getting the city to get on board with, approving permits and everything, that's its own challenge in itself. And so, yeah, so you're seeing companies not want to make those kind of accommodations for buyers anymore because they don't think they can even get it done in time. And so, yeah, and then premiums, on the other hand, that's a different story. But with those kinds of panels, there certainly highly elevated. We're seeing double, triple at what you would expect. If a owner has had something, they were at like 300, 350 a unit. New buyers can expect closer to 600, plus, depending on a lot of other factors, but just generally speaking, in that ballpark is kind of what I anticipate when I'm starting with a property.
Well, if we have any owners that are thinking of selling or just thinking about wanting to make sure their property's up to par with this new insurance requirements, can we have them reach out to you and you help them and advise them on, what they need to do?
Of course, yeah, I'd be glad to.
I mean, I think that'd be a big resource because we're, as housing providers, there's always constantly something new coming down the pipe here, right? It was a lot of rent restrictions, COVID. Now we're dealing with insurance. We got changes in interest rates. There's always something, but this is something that's really, really important. We're seeing it on the sales side. We're still getting transactions done, but we are being proactive when we're going through the building. We're asking some of the questions that you're asking us to the sellers to make sure, what type of systems are going on. We're doing property inspections, just maybe it's exterior, maybe popping into a unit or two, and then providing our advice. But it'd be great to have you clipped in and have the owner be able to talk to you directly. I think that'd be really helpful.
Yeah, glad to do it.
What can we expect down the pike here? I know this is look, we want to be real and transparent. This is what's going on within our industry. I know this is a little bit, not the best information. That being said, what can we expect with insurance in the next 6 to 12 months? Is it going to be more or less the same? Is it going to get a little bit more tighter with the restrictions? What do you forecast here?
Yeah, I'm not sure how accurate my crystal ball is. I think you're going to see more of the same. I think you're going to see premiums increase more until there is more competition. Right now, as we've mentioned, a lot of companies have left. And I expect underwriting guidelines to continue tightening. I think premiums, I think at some point they will plateau. Obviously, can't go forever. I think more companies will want to come in as they see, some of the premiums that are being generated for these buildings. I don't expect them to go down much. So I, again, just anticipate the underwriting to continue being, strict. Premiums, probably not going down, but I do expect at some point they plateau.
So I know this is negative, but it sounds like there's some workarounds if you're proactive about it. All right, well, great. Well, look, we really appreciate you having on the channel here on Zoom. We know you're up in Northern California, and that's why we're doing the Zoom versus being here in the office. But we will certainly put your contact information below. So if anybody wants to reach out to you to get insights or possibly a quote about their property, we'll put you guys in touch.
Sounds good to me.
All right. Well, thanks again for being on the channel. We look forward to having you again in the future, and we really appreciate it.
Yeah, you got it, Dan. Anytime, and you guys take care.
All right. Thanks so much.